Good afternoon, class. Today I will discuss variable interest entities, and I will also discuss how to consolidate a primary beneficiary with its variable interest entity. So, Chapter 6, Learning Objective 1, describe a variable interest entity, a primary beneficiary, and the factors used to decide when a variable interest entity is subject to consolidation. So, variable interest entities, also known as VIEs, they were previously known as special purpose entities. Most of the VIEs are established for valid business purposes. They're established as separate business structures, usually a trust, a joint venture, a partnership, or another corporation. VIEs sometimes have no independent management or employees. Common examples of VIE activities: transfers of financial assets, leasing, hedging financial instruments, research and development. The benefits of a VIE: often eligible for a lower interest rate than their prime beneficiary, and they have a low cost of financing of assets. So governing agreements limit activities and decision making with VIEs. So variable interest entities, the primary beneficiary. So enterprises that create VIEs may not own any of its voting stock. Prior to current consolidation requirements, enterprises left VIEs unconsolidated in their financial reports, meaning that until recently they didn't even include them at all. Primary beneficiaries typically exercise its financial control through governance documents or contractual agreements, giving it decision-making authority over the VIE. Primary beneficiaries must consolidate in its financial statements the VIE assets, liabilities, revenues, expenses, and non-controlling interests. So characteristics of VIEs. VIEs generally have assets, liabilities, and investors with equity interests. Activities are strictly limited, sometimes for one purpose. The role of equity investors can be minor. They may serve simply to allow the VIE to function as a legal entity. Because they bear relatively low economic risk, investors may be provided only a small rate of return, and another party, the primary beneficiary, contributes substantial resources, loans, or guarantees to enable the VIE to secure additional financing to accomplish its purpose. Primary beneficiaries may guarantee the VIE's debt, assuming the risk of default. Contractual arrangements may limit returns to equity holders, yet participation rights provide increased profit potential and risk to the primary beneficiary. Beneficiaries' economic interests vary depending on the VIE's success, hence the term variable interest entity. So risk and rewards are not distributed according to the stock ownership, but according to the variable interest. So VIE's risk and ownership. Variable interest increases a firm's risk as the resources it provides or guarantees to the VIEs increase. With increased risk comes incentives to restrict the VIE's decision making. A firm with variable interest will regularly limit the equity investors' power through the VIE governance documents. Investors are the owners of the VIE, but they may retain little responsibility of ownership, risk, and benefits. Investors may cede financial control of the VIE to the variable interest in exchange for a guaranteed rate of return. So prior consolidation of VIEs. In the past, assets, liabilities, and results of operations for VIEs and other entities frequently were not consolidated with those of the firm that controlled the entity. These firms invoked a reliance on voting interest as opposed to variable interest to indicate the lack of controlling financial interest. As noted by GAAP literature, legacy FASB standard FIN 46R requires the primary beneficiary, regardless of their ownership, to consolidate the VIE. One of the reasons this came about is, as you well know, that we've talked about it in many chapters in many books, the Enron scandal. So examples of VIEs. So Exhibit 6.1. The variable interest in a variable interest entity are contractual ownership or other pecuniary interest in an entity that change through changes in an entity's net asset value. Variable interest absorbs portions of variable interest entity expected losses if they occur, or receive portions of entity's expected residual income if they occur. The following are some examples of the variable interest and related potential losses or returns. So here you have a variable interest and your potential losses and returns that coincide with those variable interests. So identification of a VIE. And an entity qualifies as a VIE if either of the following conditions exist. So, total equity at risk is not sufficient to permit the entity to finance its activities without additional subordinate financial support provided by parties, including equity holders. Also, equity investors in VIE as a group lack any of the three characteristics of a controlling financial interest. So, one, the power through voting rights or similar rights to direct the activities of an entity that must significantly impact the entity's economic performance. Two, the obligation to absorb the expected losses of the entity. Or three, the right to receive expected residual returns of the entity. So, identification of the primary beneficiary of the VIE. Once a firm has a relationship with a VIE, the firm must determine whether it qualifies as the VIE's primary beneficiary. An enterprise with a variable interest with a controlling financial interest in a VIE is the primary beneficiary and will have both of the following characteristics: the power to direct the activities of the VIE that most significantly impact the entity's economic performance, and the obligation to absorb losses that could potentially be significant to the VIE, or the right to receive benefits from it that could be significant to the VIE. These characteristics mirror those that equity investors often lack in a VIE. The primary beneficiary will absorb a significant share of the VIE's losses or receive a significant share of the VIE's residual returns, or both. The fact that the primary beneficiary may own no voting shares whatsoever becomes insequential because they are not effective they did not effectively give equity investors power to exercise control. Careful examination of VIE's governing documents and who bears risk is necessary to determine whether a reporting entity possesses control over a VIE. So, example of a primary beneficiary and a consolidated VIE. So, Twin Peaks, a power company, seeks to acquire an electric generating plant for $400 million to expand its market share. It expects to sell the electricity generated by the plant acquisition at a profit to its owners. Twin Peaks' general credit rating allowed for a 4% annual interest rate on debt issued. It explored establishing a separate legal entity whose sole purpose would be to own the electric generating plant and lease it back to Twin Peaks. So that would end up being a VIE. So the separate entity will isolate the electronic generating plant from Twin Peaks' other risky investments and liabilities and provide specific collateral. An interest rate of 3% on the debt is available, producing before tax savings of $4 million per year. So that's why they're saying the VIE financing normally is cheaper than the beneficiaries. So to obtain the lower interest rate, however, Twin Peaks must guarantee the separate entity's debt and maintain its own predefined financial ratios and restrict the amount of additional debt it can assume. So Twin Peaks established Power Finance Company, designed solely to own, finance, and lease the electric generating plant to Twin Peaks. The documents governing the new entity specifically specified the following. The sole purpose of Power Finance is to purchase the ACE electronic generating plant, provide equity and debt financing, and lease the plant to Twin Peaks. Number two, an outside investor will provide $16 million in exchange for a 100% non-voting equity interest in Power Finance. So Power Finance will issue debt in exchange for $304 million. Twin Peaks guarantees the debt because the $16 million equity investment is insufficient to attract low-interest debt financing. Twin Peaks will lease the electric generating plant from Power Finance in exchange for payments of $12 million per year based on a 3% fixed interest rate for the debt and equity investors for an initial 5-year lease term. At the end of the 5-year lease term or any extension, Twin Peaks must do the following: renew the lease of the 5 years subject to the approval of the equity investor, purchase the electronic generating plant for $400 million, or sell the electric generating plant to an independent third party if the proceeds of the sale are insufficient to repay the equity investor. Twin Peaks must make a payment of $16 million to the equity investor. So conditions for consolidation of Twin Peaks Electric Company and Power Finance Company. So evaluating whether Twin Peaks Electric Company must consolidate Power Finance Company, 2 conditions must be met. Power Finance must qualify as a VIE by either an inability to secure financing without additional subordinate support, or a lack of either the risk or losses of entitlement to residual returns or both. Twin Peaks must qualify as the primary beneficiary of Power Finance. So Power Finance Company's VIE status. In assessing the first condition, several factors point to VIE status for Power Finance. Its owner's equity comprises of only 4% of the total assets, far short of the 10% benchmark. Twin Peaks guarantees Power Finance debt, suggesting that insufficient equity to finance its operations without additional support. And number three, the equity investors appear to bear almost no risk with respect to operations of ACE electric plant. These characteristics indicate that Power Finance qualifies as a VIE. So for the second condition for consolidation, an assessment is made to determine whether Twin Peaks qualifies as a Power Finance's primary beneficiary. So now that you determined that Power is a VIE, who are their beneficiary? Let's see if Twin Peaks qualifies. So Twin Peaks has the power to direct Power's finance activities, but to qualify for consolidation, Twin Peaks must also have the obligation to absorb losses or the right to receive returns from Power Finance. Twin Peaks will pay a fixed fee to lease the electric generating plant, operate the plant, and sell electric power in its markets. If the business plan is successful, Twin Peaks will enjoy residual profits from operating, while Power Finance equity investors receives a fixed fee. If electricity prices fall, revenue generated may be insufficient to cover Twin Peaks lease payments, but the VIE equity investors are protected from the risk. If the plant's fair value increases significantly, Twin Peaks can exercise the option to purchase the plant at a fixed price and either sell it or keep it for its own future use. If Twin Peaks sells the plant at a loss, it must pay the equity investors all of their initial investment, furthering the loss to Twin Peaks. These elements point to Twin Peaks as a primary beneficiary of VIE, meaning it must consolidate the VIE's assets, liabilities, and results of operations with its own. So financial reporting principles for consolidating VIEs, initial measurement issues. So financial reporting principles for consolidating VIEs require assets, liabilities, and non-controlling interest valuations. These valuations, initially with few exceptions, are based on fair values. If the total business fair value of the VIE exceeds the collective fair value of its net assets, goodwill is recognized, as in any transaction. Initial measurement issues, collection of fair values. If the collection fair values of the net assets exceed the total business fair value, the primary beneficiary recognizes a gain or a bargain purchase. Assuming that the debt and controlling interests are stated at fair values, Twin Peaks includes its consolidated balance sheet, electric generating plant at $400 million, long-term debt at $384 million, and non-controlling interests of $16 million. After initial measurement, all intra-entity transactions between primary beneficiary and VIE must be eliminated in consolidation. VIE's income must be allocated among the parties involved, equity holders and primary beneficiary. The distribution of income is typically specified in contractual agreements. So learning objective 6-2. Demonstrate the process to consolidate a primary beneficiary with a variable interest entity. So now that we've gone over what a VIE is, what a primary beneficiary is, and an example of a VIE and a primary beneficiary, now they're going to discuss how to consolidate the two. So consolidation of a primary beneficiary and a VIE illustrated. So assume that January 1st, 2018, Prescott Corporation loans Valente Incorporated, a business entity, $2.2 million due January 1st, 2023. Valente had been unable to secure the financing needed to continue its operations. As part of the loan agreement, Valente agrees to provide to Prescott during the next 5 years 5% annual interest, the market rate on the loan, decision-making power over Valente's operating and financing activities, and 100% participating rights to all Valente's profits, less a $7,000 guaranteed annual dividend to Valente's common shareholders. So the agreement options. At the end of the 5-year agreement, Prescott has the option of either acquiring ownership of Valente for $500,000 or extending the original agreement for an additional 5 years. As a result of the agreement, Valente is a variable interest entity, and Prescott is its primary beneficiary that requires consolidation. So primary beneficiary and VIE balance sheets. At January 1st, 2018, Prescott estimated the fair value of Valente's common stock at $143,000. The $125,000 difference between the fair value of the common stock and Valente's book value was attributed entirely to a patent technology with a 5-year estimated remaining life. So here we have an illustration of Prescott and Valente's balance sheets independently at January 1st, 2018. So consolidation worksheets at the date of acquisition. So here we have Prescott and Valente's financial information. You have their adjusting entries and eliminations, non-controlling interest, and then a consolidated balance sheet. And so here, for example, we've discussed this in previous chapters where these consolidated entries, S, A, and P, where S will eliminate the owner's equity, and P is going to eliminate the long-term debt or any loans, and then A is the allocation of excess of fair value. In this case, is a patent, the patent technology. So if you follow those entries, S, A, and P, they'll lead you to the consolidated balance sheet. So consolidated worksheet subsequent to initial measurement. This is following the initial acquisition year. And here you have Prescott and Valente again, the adjustments and eliminations, non-controlling interest, and your consolidated financial column. And so again, the SAP, and here you have E and I. So each one is illustrated here. Consolidating entry S is to eliminate the beginning stockholders' equity of VIE to recognize 100% equity ownership of the non-controlling interest. And you have a debit to retained earnings, a debit to common stock, and a credit to non-controlling interest. Consolidation entry P from the worksheet, previous worksheet, is to eliminate the long-term receivable and debt representing Prescott's initial investment in Valente, the $2.2 million, with a debit to long-term debt and a credit to the loan receivable. And consolidation IE, to eliminate the intra-entity interest related to the loan from Prescott to Valente, was $110,000, a debit to interest income and a credit to interest expense. Consolidation entry A, to allocate the excess fair value of the patent technology and credit the non-controlling interest as part of the fair value valuation of the date of Prescott obtained control, which is $125,000 debit to patent technology and a credit to non-controlling interest. And consolidation entry E, to amortize the excess fair value of allocation to unpatented technology of its 5-year remaining useful life, which is $25,000, a debit to operating expense and a credit to patent technology. So again, this is the explanation of the worksheet entries. So consolidation worksheet process subsequent to initial measurement. Consolidation of a VIE with its primary beneficiary follows a similar process as if the entity were consolidated based on voting interest. All intra-entity transactions between the primary beneficiary and the VIE must be eliminated in consolidation. Because the VIEs typically have non-controlling interests, an appropriate allocation of the VIE's net income requires a close examination of the underlying contractual arrangement between the primary beneficiary and other holders of variable interest. Variable interest entity disclosure requirements. So enhanced disclosures are required for any enterprise that holds a variable interest, including the VIE's nature, purpose, size, and activities, significant judgment and assumptions of enterprise making and determining whether it consolidate a VIE or disclose information its involvement in the VIE, nature of restrictions of the consolidation of VIE's assets, and on the settlement of liabilities reported by an enterprise in its statement of financial position, including the carrying amount of such assets and liabilities. The nature of and changes in the risk associated with an enterprise involved with the VIE, and how an enterprise's involvement in the VIE affects the enterprise's financial position, financial performance, and cash flow. Comparison of international accounting standards. So under U.S. GAAP and International Financial Reporting, IFRS, the controlling financial interest is the critical concept in assessing consolidation by reporting an enterprise in the VIE. Current reporting standards differ across these jurisdictions. IFRS has one model for all entities regardless of whether control is evident by voting interest or variable interest, and US GAAP has a separate model for assessing control for variable interest entities and voting interest entities. Financial Accounting Standards Board continued to deliberate its consolidation policies and procedures. ISAB has issued updated standards that cover and define control to encompass all possible ways in which an entity can exercise power over another. So learning objective 6-3, demonstrate the consolidation procedures to eliminate in all entry debt accounts and recognize any associated gain or loss created whenever one company acquires an affiliate's debt instrument from an outside party. So now we're adding an additional element in debt. So intra-entity debt transactions, a company cannot lend money to itself. So an intra-entity investment in debt securities and related debt accounts must be eliminated in consolidation. Corresponding receivable and payable and revenue and interest from consolidated financial statements must be eliminated as well. Because no money is owed to or from an outside party, these reciprocal accounts must be eliminated in such a subsequent consolidation. Acquisition of affiliates debt from an outside party. So the purchase of an affiliate's debt instrument from an outside third party can create difficulties in consolidation. If the parent purchases all or part of outstanding subsidiary bonds in the open market from a consolidated view, the combined entity has reacquired its own bonds. Although the individual companies continue to carry the debt, the investment in their individual financial records from a consolidation viewpoint, this liability is effectively retired as of the debt reacquisition date. The debt is no longer owed to a party outside the business combination. Subsequent interest payments are simply intra-entity cash transfers. If the purchase price equals the corresponding carrying amount of the liability, an affiliate's bond or note acquired from an unrelated party poses no significant consolidation problems. Reciprocal balances with the individual records would always be identical in value and easy offset in each subsequent consolidation. If the cost paid to purchase the debt is more or less than the liability carrying amount on issuing the company's financial records, the gain or loss must be recognized immediately by the consolidated entity. So intra-entity debt transaction example, so Alpha and Omega. So Alpha Company owns 80% of interest in Omega Company outstanding voting stock. On January 1st, 2015, Omega issued $1 million in 10-year bonds at 9%. Omega sold the bonds at $938,555 to yield an effective interest of 10%. On January 1st, 2017, Alpha purchased the bonds back for $1,057,466 with effective interest rate of 8%. The difference between the $1,057,466 payment and the January 1st, 2017 carrying value of the liability must be recognized in consolidated statements as a gain or loss. Alpha paid $110,850 in excess of the recorded liability, and here you have the equation. Due to periodic amortization and the consolidation entity must recognize a loss of this amount. The bond is retired. No further reporting is necessary by the business combination after January 1st, 2017. Neither company separately accounts for the event in this matter. So after the bond retirement, Omega retains the $1 million debt balance with its separate financial records and amortizes the remaining discount each year using the effective rate method. Annual cash interest payments of $90,000, 9% continue to be made. Alpha records the investment at the historical cost of $1,057,466, an amount that requires specific periodic amortization. Alpha receives $90,000 in interest payments paid by Omega. That's the end of this chapter. Please go over and reread chapter 6